Every day, I talk to people who say they're working on their credit. But when I ask what that means, they tell me someone is disputing everything on their report. That's not the same as fixing your credit.
Ready to elevate your credit understanding and score? With insider tips and a plan, you can take action to improving your score, which can save thousands in unnecessary finance charges. Let's tackle today's topic with your coach, Credit Kristi.
Hey friends, it's Kristi, your credit coach. Thank you so much for joining me for another episode. Today, we're talking about how to actually fix your credit. I use the word actually very intentionally because I cannot tell you how many future home buyers tell me I'm working on my credit. And when I ask them what that means, they often say, I hired a credit repair company, or they're disputing everything for me. Friends, disputing everything is not the same thing as fixing your credit. Sometimes a dispute is completely appropriate. Sometimes it is absolutely necessary. But disputing accurate information just because you do not like it is not a long-term credit strategy. It's more like putting a Band-Aid over your check engine light and hoping the car appreciates your optimism. So today I'm going to explain a few things. What a credit repair company can and cannot do, and I am not one. So I don't have a dog in this fight. I'm just sharing with you what I know to be true about credit repair companies. When you should dispute something, when a dispute is a complete waste of time, and how disputes can affect a mortgage application. So let's get into it. First, we need to separate three different activities when it comes to fixing your credit. It's correcting credit, improving credit, and protecting credit. Let's start off with correcting. Correcting your credit means identifying information that is genuinely inaccurate. It's incomplete, it's duplicated, it's outdated, or it's simply fraudulent. And you can go on to Experian.com, Equifax.com, and TransUnion.com and get that corrected. I had my husband go in and look at his report, and his name had a lot of misspellings. And then there was this associated address in Arizona. And outside of visiting Arizona once, we've never lived there. He's never lived there. And it looked like somebody was attempting to start a credit card with an Arizona address and the misspelling of his name. So he went in, disputed it, asked for it to be removed, stating he's never been there. They verified that and the misspelling of his name and updated his credit profile. But even addresses can have an impact on your credit score. Improving your credit means changing the financial behaviors and account balances that are affecting your credit profile. Protecting your credit means making it harder for someone else to open accounts in your name or damage the credit you've built. So after he's corrected it, we looked at where we can make improvements. And his balance was a little bit high on one of the credit cards. So I gave my husband a game plan on what that balance should always reflect to improve his credit score. And then protecting, you're going to freeze your credit to make sure other people can't access your information. And so we'll get into that in just a few minutes. But the correcting, improving, protecting, those are three different jobs. And a dispute can correct information. The problem is that many people have been sold the idea that disputing an account somehow erases the history behind it. And it usually does not. Federal law gives you the right to dispute information that is inaccurate or incomplete. The bureaus generally must investigate when a dispute is made, and they typically have up to 30 days. But the FTC is very clear. Accurate and timely negative information generally cannot legally be removed simply because you want it gone. So here's what sometimes happens. A credit repair company sends a large number of disputes. During the investigation, an account may temporarily disappear or stop being considered as part of your credit score in that algorithm. And then you see that score increase and think, it works. But if the creditor verifies that that information is accurate, the item may be updated with language saying that it is actually being reported correctly. That debt was not repaired. The underlying history did not magically become false. And now the consumer, you, may have paid hundreds or even thousands of dollars for letters you could have submitted yourself for free. And a temporary deletion is not the same as a permanent correction. So when would you dispute something? You should dispute an item when you have a legitimate reason to believe it is wrong. A few examples include the account does not belong to you. You paid it on time, but it's reporting late. the balance is incorrect. The same debt is being reported more than once. An account is closed, but it's being reported as open. Or if you're listed as the primary borrower on a credit card, but you're actually only an authorized user. A collection sometimes remains on the credit report longer than 7 years from the date that it became a collection. So if that's the case, you can ask for that to be removed. It shouldn't remain on that report. Or what about an account that resulted from identity theft? That should absolutely be disputed. But sometimes a creditor reports dates or payment history or account status incorrectly, and that's where you can step in and be an advocate for yourself. But before filing the dispute, gather your evidence. That could include bank statements, payment confirmations, account statements, a letter from the creditor saying, hey, we've updated this, but apparently it hasn't been updated on the report, any kind of identity theft documentation, payoff statement, any kind of correspondence or emails. That can help your case, and then dispute the specific error. You can't send in a vague letter saying, prove this account is mine. It's more like, this account reports a 30-day late payment for July 2026. Attached is my bank statement and the creditor's confirmation showing that the payment was received by the due date. Please correct the July 2026 payment history. That gives the person at the bureaus that's doing the investigation something concrete to review. You can dispute it directly with the credit reporting bureau, the company that is furnishing the information, or both. And keep copies of everything that you submit and everything you receive. So all of this matters, especially when you are preparing to buy a home. Some people enter the mortgage process with multiple accounts that are marked consumer disputes this account information. And they assume the dispute helped their credit, but it can create an underwriting issue. So if you are applying for and get approved for an FHA loan, FHA guidance treats disputed derogatory accounts and collection balances differently than some of the other loan programs, depending on the type of account, the total balance, the reason for the dispute, and the automated underwriting findings, which is what loan officers and underwriters go by for the approval. That disputed derogatory account may require additional documentation, or it might downgrade your approval to what's called manual underwriting. You may have heard a $2,000 figure associated with FHA. Let me break that down. The FHA guidelines includes a $1,000 threshold associated with a certain disputed derogatory account, and the $2,000 figure is connected with a cumulative balance of collection accounts. In other words, what they all add up to and how those collections must be considered in underwriting. Let me give you an example. Let's say you have 3 collections and you have a dispute out on all 3 of them. And together, the outstanding balances on those collections is $3,000. If we keep that dispute language on the credit report, your approval gets downgraded to what's called a manual underwriting situation. It's much more strict on the approval level. So your debt ratios have to be really, really low. You have to show on-time rent payments where maybe you didn't have to show evidence of rent payments in the past for the standard approval level. And it just makes things that are already a little challenging even more difficult. Now, there are exceptions to the rule. Certain medical accounts, if there is an identity theft situation and you can prove that, something along those lines. But if it exceeds $2,000 collectively in that dispute, you'll have to remove the dispute language. One might think it's quite easy to do that. I had a client that when I pulled credit, that was the situation. It was several collection accounts. I think it was about 5, and they all added up to greater than $2,000. And he only qualified for an FHA loan. There was no way we were going with a conventional mortgage. And so he called all 3 credit reporting bureaus, and this one bureau would not remove the language on 2 of his accounts. I don't think it was intentional. It just wasn't happening. So it took a couple of months, a lot of phone calls, and pulling his credit several times to be able to verify and get that removed. That could have stood in the way of him getting approved for that loan. My suggestion, don't start randomly removing disputes or adding new disputes when you're trying to qualify for a mortgage. First, speak to your loan officer and get guidance. We need to see the full picture. Removing a dispute can cause the account to be included in the score again, and that could have a negative impact on your credit score. Paying a collection could change the date of last activity or even the status being reported. So that could have an impact that we're not prepared to handle at the moment. Closing an account could reduce available revolving credit. Opening a new account could create an inquiry and lower the average age of your accounts. Credit is all interconnected, and one unintentional wrong move can affect several parts of the report. Please seek guidance from what to do and not do from your loan officer before making any actions. Now, if you're considering buying a house maybe a year or two from right now, or you're just interested in actually doing your own step-by-step credit fix, here's the process I recommend. Step 1, pull all 3 credit reports. You'll start with annualcreditreport.com. It's the federally authorized source for free credit reports, and that pulls in from Equifax, Experian, and TransUnion. And you can check it as often as you want to. It used to be once a month, but ever since COVID, they loosen that up and you can really pull it as often as you want to. And checking your own credit report does not hurt your score. It's not a hard inquiry. You're not applying for credit. It's just a soft inquiry, and you're absolutely allowed to do that with no impact to your credit profile or credit score. Review all 3 because I have seen where Experian reports something that TransUnion does not, or vice versa. When you're reviewing, make sure that the information is really identical from all 3 credit reporting bureaus. So make a list of anything that reflects differently from the other bureaus: open accounts, closed accounts, late payments, collections, charge-offs, hard inquiries that are listed. They should be listed showing in the last 2 years. Any addresses. If there's an address affiliated to you that you've never lived at, it wasn't your parents' home address, it wasn't a place that you rented at or stayed with a friend, but it's on your credit report, take note of that because you're going to ask for that to be updated and removed. Names that show up for you. Now, if you're married, it should reflect your maiden and married name if those are 2 different names. But in the example earlier about my husband where his last name was misspelled, you're going to want to remove that. Sometimes when you apply for a credit card, like let's say you went to Old Navy and they said, would you like to save 10% today? And you go, yes, great, let's open a credit card. And the person mistypes your name. That is now affiliated on your credit profile and will stay there for a lot of years unless you dispute it and remove it off. Employers are often listed. Your income is not, but employer agency information often is. Don't focus only on the score. We're just looking at the information being reported. Step 2, correct actual errors. So dispute only the information that's inaccurate, incomplete, duplicated, outdated, or if it appears to be fraudulent. At each one of the credit reporting bureau's websites, there's information on how to dispute, either online or by mail, and you'll want to have that documentation ready. Be very specific, keep records, and follow up after that investigation period if you haven't heard back within the first 30 days. Now, if an account is being reported accurate, well, just let it age. I had somebody reach out to me just this morning saying I accidentally had a late credit card payment and it was just an honest oversight. And he felt terrible. And he and his wife want to buy a home next year. And come next year, he's going to be just fine. As long as there's on-time payments moving forward. Your payment history makes up 35% of your overall credit score. So make sure to keep those payments perfectly on time. I would encourage you, sign up for push notifications from the app or your login on their website. Ask to get texts or emails if a payment isn't made on time. You might have a late fee, but you might catch it early enough that it doesn't hit your credit report. Okay, so now step 3, protect every payment going forward. Perhaps a strategy is you can set every account to at least the minimum payment through an automatic payment a few days before that amount is due. And that way you'll never miss a payment. And you can go in and make any additional payments anytime you want to for any amount. You could also put an alert on your calendar several days before each due date just to remind you to go in and make sure that that minimum payment has been made. And I'm not telling you to pay the minimum. I am just suggesting because you're busy with work and life or a forgotten password or what have you left on vacation. We don't want anything to turn into a 30-day late payment. And step 4, attack those revolving balances strategically. Revolving means credit card balances. If your goal is credit score improvement, paying down a credit card can often have a more immediate scoring impact than sending the same amount to an installment loan. Why? Credit cards are revolving accounts, and scoring models consider how much of your available revolving credit you are using. It's called debt utilization. Let me give you an example. If a credit card has a $5,000 limit and it's reporting a $4,500 balance, you're using 90% of that account's limit. If you pay down that balance to say $1,000, that utilization becomes 20%. You went from nearly maxed out to below that magic percentage of 30%, and your score will soar. That change is much more meaningful to the score than paying an auto loan from, say, $20,000 to $18,000. Installment balances still matter, but it's really more about the payment history on installment loans. Revolving utilization is a significant part of the amounts owed category. Look at both your overall utilization across any credit cards and your utilization on each credit card. They both take part in that utilization calculation. Do not assume that moving every balance onto a nearly maxed out credit card will help simply because the total debt stayed the same. And also, the balance reported to the bureaus is commonly the statement balance, not necessarily the balance you have today. I know on my Capital One app, it shows me the date my payment is due, and it also shows me that statement date. And that statement date balance is typically the one that is reported to all 3 credit reporting bureaus. It's not like on the first of the month, everything is washed anew and starts all over. No, every credit card or installment loan is going to have its own statement balance date. And that's typically the date or around there that your creditors will report the information to the bureaus. I mean, you could even pay your credit card in full every month and still have a high balance reported if that statement closes before the payment posts. So I would encourage you to be strategic, and if you intend on having that balance reflected as being paid in full, make that payment in full just before the statement date for that credit card so that balance would reflect appropriately. If on your app it doesn't show what date that statement gets reported or it closes out, you can call that creditor and just ask. Now, step 5, stop closing good older accounts without a reason. If you close a credit card, it may reduce your total available credit and increase your utilization percentage. It also could affect your length of credit history. Your length of credit history is a smaller percentage of your overall credit score algorithm. However, your length of credit history isn't from the first date of your first credit line. It's actually based on your open and active accounts that you currently have. Now, if you have an expensive card, for instance, it has an annual fee, or just having that credit card creates a spending problem, closing it might be the right financial decision. But don't close an older, no-fee card simply because you paid it off and assume closing it earned you some kind of win. It would actually hurt more than it helps. Sometimes the best move is to pay it off, leave it open, and use it occasionally for a small recurring charge that is automatically paid in full. Set it and forget it. Step 6, consider an authorized user account, but be careful with this one. Becoming an authorized user on someone else's well-managed credit card can help people establish or strengthen their credit history, but choose that person and that account carefully. Ideally, the card should have a long positive history, no late payments, a low reported balance, and a reasonably high limit. You do not need to receive or even use that credit card. It's just simply the borrowing of that credit card's history on your credit profile. Now, if that primary cardholder runs up the balance or pays it late, that account may hurt you instead of helping you, and then you would want to get removed off as an authorized user. If you are preparing for a mortgage, talk with your loan officer before adding yourself to any accounts. And then now step 7, be careful with collections and charge-offs. Paying a collection is not the same as deleting it. A paid collection may be viewed more favorably by the credit profile algorithm and also by the lender. But sometimes, and I've experienced this through clients, Paying off an older collection can sometimes have a negative impact on that credit score because that date of last activity is now messed with. And it's almost like picking a scab off of an older wound. Now you've just kind of started it all up again, even though now it's going to report as paid or settled, satisfied, something along those lines. So do talk to your loan officer first. But generally speaking, paying off a collection or a charge off will have a positive effect more so than a negative effect. But again, not always. So follow their guidance. And if you are planning on paying an old collection, find out if the creditor will delete it, update it, or just merely show a zero balance. A lot of times, an old collection, they will remove it, delete it completely. It's called pay for delete. They'll remove it from your credit report. Now, if it was, let's say, a credit card that you went really late on and it became a collection account, that original creditor, that credit card company cannot and will not delete it. You've got to wait for that 7 years for it to drop off. But that collection account could get deleted. Again, talk to your loan officer because this is where personalized guidance matters. Step 8, stop applying for random credit. New credit generally makes up about 10% of a FICO score. So don't open new accounts simply because you are chasing a store discount. Do not finance furniture before closing on your house, even if it's 0%. That can mess things up for your approval. If you're thinking about buying a car and buying a house, buy the house first and then go buy the car. A new account can create a new hard inquiry, a new monthly obligation, a lower average account age, and a higher debt to income ratio. Not to mention a potentially stressed out loan officer. So during the mortgage process, ask before opening, closing, co-signing, financing, or transferring anything. And then finally, let's talk about protecting your credit with a freeze. One of the strongest ways to protect your credit is to place a security freeze with all 3 bureaus. A freeze restricts prospective creditors from accessing your credit file, making it harder, if not impossible, for an identity thief to open a new account in your name. Freezing and unfreezing your credit is free. You must contact Equifax, Experian, and TransUnion separately to do so. So when you set up an account with each, you can go in and freeze or take off that freeze at any time. A couple of things to know. A freeze does not hurt your credit score. You can temporarily lift it when you legitimately apply for credit. Do not confuse a freeze with a paid credit lock or credit monitoring subscription. It's not the same thing. A freeze can help prevent a new account from being opened in the first place, but you'll have to remove that freeze if you are going to apply for a credit card, an increase on a credit card limit, a car loan, or a mortgage. A couple of other friendly reminders: review your bank and credit card activity regularly. Make sure that what is going on there is authorized by you. I would encourage you to turn on transaction alerts. Every time my credit card is swiped, I get a notification of it. Try to use unique passwords across the board because unfortunately, credit breaches do happen. Consider enabling a multi-factor authentication. And obviously, avoid giving personal information to unsolicited callers. Every once in a while, go in and review all 3 credit reports and look for that inaccurate information. So finally, let's talk real quick. What is your credit report actually measuring? It does not measure your net worth. It does not measure your intelligence. It doesn't measure if you're a good person, a loving parent, a hard worker, or somebody with tremendous potential. You are so much more than your credit score. Your score is a risk prediction tool. At its core, it's evaluating patterns that help a lender estimate if we extend credit to this person, how likely are they to repay as agreed? In everyday language, your report is measuring evidence of financial trustworthiness. Have you paid as agreed? How much of your available revolving credit are you using? How long have you managed your accounts? Have you recently applied for multiple or new obligations? And what types of credit have you managed? FICO describes the 5 categories as payment history, amounts owed, length of credit history, new credit, and credit mix. But here's what surprises most people. Your credit score is not based on your income. It doesn't know how much money you have in your checking or your savings. It does not know your net worth. It does not reward you because you have a high salary. A person earning $50,000 who manages credit consistently may have a much stronger credit score than someone earning $500,000 but misses payments or maxes out accounts. Now, when it comes to lending and loan approval, lenders consider income, employment, assets, your debt ratio, obviously your credit score, and other information when making a loan decision. But all of those items, they're not part of your FICO credit score itself. Credit is not measuring how rich you are. It is measuring how you've managed the financial trust previously extended to you. So how do you fix your credit? You do not fix it by disputing every negative account and hoping that nobody answers. You fix it by correcting real inaccuracies, protecting every future payment by making sure it's on time, reducing your credit card utilization, keeping that at 30% or below, avoiding any unnecessary new debt. Please don't start a new credit card with Old Navy because they're offering you 10% off at checkout. Make sure you're managing those older accounts wisely and resolve any legitimate obligations strategically. Protect your identity, put those credit freezes on, and give that positive behavior, those new actions that you might be putting into play, enough time to build a new pattern and improve that credit score. Credit improvement is rarely one dramatic move. It's usually a series of boring or responsible decisions repeated long enough to become an improved score. And honestly, boring can help you buy a house. So if homeownership is one of your goals, do not wait until you think your credit is perfect before speaking with your mortgage professional. You may be closer than you think. And the plan that you found online or the person you're listening to on TikTok, that may not be a perfect plan for you. So seek out a qualified mortgage professional to give you some guidance on steps that are specific to your loan program and your needs. And I just want to remind you, your credit report tells a financial story, but it does not get to write your identity. You do. Hey friends, thanks so much for joining me for another episode. And until next time, stay well.
Subscribe now and share with a friend to stay in the loop for new credit content and insider tips to maximize your credit knowledge. And follow Credit Kristi on Instagram.